Welcome back to the channel, and as always, if you are copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're gonna look at a short idea for today. The name of the company is MicroChip Technology Incorporated, ticker MCHP. So a few things with this one. They are reporting earnings on the 6th of May. As you can see, that's not that far from us. It's a market cap of almost 50 billion, which is the kind of profiles that we look for in a short. And it's part of the semiconductors industry, which arguably you could have been short for quite some time. So first thing that we see when we look at this company over here is that this is a stock that has been linear. It's been sideways for quite some time. Uh, if we go back in time, years, as a matter of fact. So why am I shorting this now? Well, I have identified this company as part of different sectors that I've been screening for shorts, and a few things that I have noticed stand out when I look at this name. So first of all, if we look at the panels that we have here, uh, one of the things that come up quite quickly is the very rapid spike in valuation that we have here. So since October last year, when the stock was trading at 12 times, up until now, the valuation has almost increased by 3. So it's gone from a multiple of around 13 to 33 in a relatively short space of time. At the same time, what we see as well is that if we start looking at the month of uh, probably February, yeah, more like April, there's been an increase of short interest, indicating that the market feels increasingly bearish about this name. Now, the MACD as well indicates that could be some movement going on here. But ultimately, I would want to enter this name preferably around the levels that we see here that were reached previously. And why am I taking that direction? Well, when we look at the valuation which I alluded to before, let's go back in time to see how that stacks up. Because I don't see this valuation justified based on what the company is going through. If we take a longer view, you can see that the current multiples that we're sitting at were reached back in 2009, and the only time when they were reached before that was during the dot-com bubble, right? So we're sitting around here. Yes, it did go a lot higher than that, but the point is that since then, it's been nowhere near uh, the levels that we're seeing before, right? So let's take a bit of a normalized period. So we're excluding the dot-com bubble, we're excluding the 2008, 2009 crash. Since then, it's been sitting around between 12, mid-teens, high teens, up to the low 20s. Even during uh, the pandemic, 2021, where the market was completely frothy and exuberant, the maximum that it reached was 21 times, and now it's sitting at 33. Now, the interesting thing about that is that if we look at how that equates to its 10-year history, the indicators are clearly showing up that this is very high indeed. And how could it be? Because we already have several market leaders, some thriving like NVIDIA, some others like Intel struggling a little bit. And that's what is, in my opinion, quite interesting. So we have a differential, a bit of a gap between the PE1 and the PE2 for the stock of 18 versus 28. So I think there's room for the valuation to adjust here because even though we have the differential, we have for the stock negative revenue growth, and also we have negative earnings growth. This is in a sector where you have companies that are growing their earnings 100% or more. The ones that are maybe not uh, so new, they're more established names, again in the 20 billion plus market cap. They are growing those earnings at 25, sometimes 40%. So this one, I feel, is at the moment overvalued. Let's look at the estimate. So you have a very long-term representation here of the stock price against the next 12 months PE. So we see how in some periods in the early 2000s, there was a decent gap on the upside. This gets eroded a little bit. And then again, in that normalized period that we look at just now, that gap is maintained. Then it gets expanded in the bull market during the pandemic. 2022, the market struggles, and here we are now, right? So you have a really big gap now between the next 12 months EPS and where the stock market is. So to me, that indicates that's room to the downside, uh, driven not only because of this gap, which does not reflect the previous company fundamentals, but also driven by those fundamentals that we just looked at. Now, we look at the estimates. They have been revised downwards. This is because there's been lack of demand from the sector for the processors, the microchips that they manufacture. Now, the interesting thing about that is that the company in the earnings call could not indicate when they expect sales to rebound. And the reason for that is because they lack long-term supply agreements. So management guided that gross margin is going to see further declines. And at the same time, their debt to equity ratio is above other peers like ADI and TXN. And that's something that in the past caused the stock to drop further versus competitors. Uh, Now, if we look at uh, how they compare to the sector, you may remember our previous video, which was a long play for SMTC displayed here. So that's a position that I entered. I think that was around here before they announced earnings, which they beat. And so I'm sitting now in a long position with the stock, and I'm looking to hedge my risk in that position with a short play. So therefore, I'm looking, this is part of the reason why I'm looking at this sector, at a short leg that I can hedge that position. And so there's plenty to choose from. So here's the interesting thing to me. SMTC, I explained the reasons why I'm long. NVIDIA, unless you've been living under a rock for the last couple of years, there's very clear reasons why they're thriving. And here's the interesting thing. On the spot number 3, we got this company, Microchip Technology, trading almost on par to NVIDIA, which is crazy, right? Considering that it's a company that it's got negative revenue growth, it's got negative earnings growth, it's got a multiple that is trading at a discount to the sector. So to me, that valuation does not make sense. And I think the reason for that is because the market is betting, the market is priced in a recovery into the price. So to me, that creates risk, downside risk. It creates an opportunity to short the stock. Now, I had a look at their investor relations, and one of the things that is quite interesting from them to me is short. As you see, you have sales growth expected to decrease. But one of the reasons why I wanted to go short is because in terms of geography, their exposure to Americas is relatively small, and the rest is in Europe and a good part of Asia, about half of this Asia pie chart, just over 20% is China. And I think those two regions, Europe and China, are going to continue struggling quite a bit. First of all, we have weak employment, we have weak manufacturing indices, low levels of business activity, and let's not forget that the Fed came in last week and made some comments after the latest CPI print, which was hotter than expected. Where that leaves us is you have a company here that has plenty of exposure to Asia and European currencies. And the dollar should continue strengthening based on that assumption that the Fed is not going to be dropping interest rates anytime soon. So in a way, you could say that putting this into your portfolio is a way to express that no rate hikes, not rate drops are coming anytime soon. And currently, my portfolio is not constructed that way. So for me, it makes complete sense to consider this as a short. Now, interesting thing about that as well is that there's been cycles. It's a highly cyclical industry, and we are here at part of the cycle where it could continue to go down in terms of sales. That's expected, and it's not the worst that we've seen. So we've seen growth going to even greater levels than where we are now. The cash generation, again, been fluctuating, and the profitability has been resilient over time. But here's the interesting thing: the gross margin has peaked and still is, as of last year, at fairly elevated levels. So what we're seeing here is a company that historically has found farther downside on their gross margin. I think that trend may continue due to that prospect of lower sales. So there's also something quite interesting to note, and that is what I mentioned here, the China weighting, and that's quite relevant in my opinion. I want to short China, and considering what's been happening in that region, something I found that caught my attention was, okay, so this is the price target. Currently, the stock is quite close to it. I think it's likely that as we progress into the second half of the year, it touches maybe this average and then drops. And the reason why I think that is because we have the analyst rating here, 26 different analysts covering this stock. No sell or strong sell ratings despite one, the current situation of the sector, and two, the current situation of the stock. And to me, that seems rather odd. It seems to me that the analysts are being benign in their assessment, whilst at the same time, if we see here, they have dropped their upper target and they have adjusted a little bit higher their lower target. So to me, this creates a situation where I think there could be a downgrades coming down the line. We'll have to wait to the 6th of May to see how the earnings play out. But with all that is happening in the sector, and especially considering that the valuation is rather high, it seems to me that everything needs to be going well for this company, and that is just not the case based on the information available. So for now, I'm going to keep it on the watch list, but definitely see this as a strong candidate for a short. I will probably wait and time this a little bit for a higher entry point, but the fundamentals look pretty good for me uh, to enter this as a short. So likely we'll be structuring that with options. If we wanted to enter that now, we could do a calendar spread. So long the 16th of August, 85 strike, and short the 19th of July, 85 strike, or a 2-for-1 ratio. If we reach $70, that's risk reward of 1.5 times. If we reach that level after the July expiry, we get 4. And if we go even lower, we get 5.7x return. So that's it for today. Hope you enjoyed the video. Subscribe. See you soon.